name is Jason Brooks with eMortgage Management, the Vice President of Retail Sales. And today I wanted to talk to you a little bit about mortgage rates. You know, big hot topic recently. We have a lot going on with global markets, a lot going on with our current market. The economy is getting better, things are getting stronger, and you hear all this talk about the Fed raising rates. How many times can the Fed raise rates? How many times have they raised rates? Going back just a few years ago, we were at zero. Now we're currently, I believe it's at 2.25% on the Fed funds rate, and prime is at 5.25. What does that really mean? Those rates really typically drive your credit cards, car loans, things like that. Home equity lines of credit. Those are the kind of things that are affected by that directly. Now, what does that mean in the long run? How does that affect my pocket? That's what's most important in this conversation, right? How does it affect me? What does it do to my monthly payments? I've taken some time, did a little bit of baby math. Basically for every 1/8 of a percentage point interest rate on a $100,000 loan, it's about $6.50 per month. So what we'll do is we'll just round it up to 7, make it simple. To give you an example, on a $300,000 loan, we have $7 per 100,000 on an 1/8 percentage point to rate. So that would be $21. So what's happened recently? If you just woke up, 3% fixed rate mortgages don't exist. That's been a thing of the past now for quite some time. As a matter of fact, we're crossing the threshold into the 5s as we speak. The 10-year Treasury, which is at its highest level since 2011, it actually hit that yesterday. It hit 325 on the 10-year, actually on Friday, I believe. And it's been kind of scary for a lot of folks, and I keep getting this question, well, what does that mean? And going back to last October when the Fed began to reduce its balance sheet by stopping reinvesting the interest that they were making from quantitative easing from the past, we started seeing rates go up. Last October, the 10-year Treasury was hovering right around 2.1%. Currently, we just talked about it's at 3.25, and that's pretty much an equivalent move to rate. So you've seen interest rates go up about a full percentage point, a little bit more than that actually in the last 12 months. So most people don't realize how, yes, an interest rate has a major impact on your payment. However, it's not as big as you may think. So, let's use this as an example to kind of do something. If you were looking at a house last year for $300,000 and you were going to borrow $300,000, and your interest rate today is 1 full percentage point higher than it would have been a year ago, again, that's 7 times 8, that's 0.125. So you do the basic math, and you come up with a number of about $54 for every $100,000 that you borrow. So the difference between now and a year ago, based on interest rate on a $300,000 loan size, would be approximately $165 a month in payment. So a 1% move is a huge move. It's not something that we would see in a small amount of time. So just putting that into perspective, for every 1/8 percentage point to rate for every $100,000 you borrow, it's about $7. So to get that should take some ease off. Essentially, if you're looking at a house, typically $100 or $125 a month in a payment is not necessarily going to make or break the decision on buying that property. Obviously, we've seen a lot of move in the interest rates just recently. Within the last 45 days, we've actually seen interest rates go up about 3/8%, so almost 0.5% to rate. And again, I don't know. I don't have a crystal ball. I wish I did. But at the end of the day, we're in a place in a time right now where interest rates are continuing to rise. We may see some softening of that over time, but going backwards and seeing rates at 3.5% on a 30-year fixed, that's really unrealistic to see that happen again. That's going to take, unfortunately, that would mean really bad things happening for the most part. So, I hope that helps. I hope this, if you can use that little bit of math, 1/8 of a percentage point to rate for $100,000 is $7. It gives you a little bit of leeway to kind of play with those numbers in your head. Typically when I'm talking to people about purchasing a home, I can usually qualify them for more than they want to spend. A good rule of thumb, it's about $75 for every $100,000 you borrow or for every $10,000 you borrow as far as payments. So $100,000 in loan amount is about $750 a month. So that gives you a really good rule of thumb. That includes taxes and insurance, principal and interest. And in most cases, it would include mortgage insurance if you weren't putting 20% down, if you were doing a conventional loan or an FHA loan. With a VA loan, you obviously do not have that. You don't have monthly mortgage insurance. So that's a good rule of thumb to kind of, play with in your head, that you can get a good feel for what is my payment going to look like at a certain loan size And if interest rates went up 1/8 of a percentage point, is that going to make me not qualify, or is that going to make my payment go too high? Again, it's a very small number, and I hope that helps. And Jason Brooks, City Mortgage. Have a good day.